Let's have a look at task 4 from the first sample assessment for cash and financial management. So this is about cash budgets and the impact on liquidity. Remember, liquidity is about how much cash we have and whether we can meet our short-term obligations with the liquid assets that we have. So the information given to us is that Flush Limited is a supplier of bathroom fittings. The directors have identified significant capital expenditure requirements in the coming months. Levels of inventory will increase due to the rapid expansion of the business. This will facilitate the increase in demand from customers. The company has recently introduced a system to forecast cash budgets, in addition to the operational budget which has been prepared for many years. Purchases are all credit-based, and the company sometimes takes advantage of prompt payment discounts. However, this is becoming a less regular occurrence. Approximately 20% of the sales are cash-based. However, the majority of customers have a credit facility with Flush. The company has no formal credit control processes. And we're asked to explain 3 benefits of Flush Limited using cash budgets. Now, in terms of benefits of using cash budgets, possibly you've already memorized some examples of this, but this question is asking us specifically to think about the benefits of Flush using them. And therefore it's important that you use the information that's provided in the scenario in the text. So for example, it tells us the directors have identified significant capital expenditure requirements in the coming months. So we need to make sure that we have enough cash to be able to buy these new assets. So in the suggested solutions, it says the effect on cash will be considered in the planning process. So decisions such as how and when to finance capital expenditure can be facilitated. So yes, it's going to be important for us to have a cash budget, because if we can see in the budget that we won't have enough cash to buy those new assets, then potentially we may need to take out a loan to be able to do that. The text also talks about rapid expansion. And we'll need to increase our inventory to be able to meet the demand from that extra expansion. So in the suggested solution, it says that cash forecasting will assist with liquidity management, which is the management of working capital. Remember, inventory is part of our working capital. When a business is expanding, it is essential to ensure that there are sufficient levels of cash to support that expansion. So again, do you notice how the suggested solution is really linked with the information provided in the scenario? So it's really important that you use that scenario to help you to construct your answer. The scenario also tells us about prompt payment discounts, although we're taking advantage of those less frequently now, and also that some of our sales are cash-based, and therefore 80% of the sales are on a credit basis, and we're going to be paid later. So that's why the suggested solution says the timing of receipts and payments are taken into consideration, such as when taxation is due. Although in this particular question it doesn't refer to tax, but yeah, that's a valid comment. The effects of lagging will be allowed for. And remember, in this particular question it talks about those prompt payment discounts, so we may be paying earlier to get those discounts. And similarly, our customers are going to either pay now or pay later. So we need to think about that lagging and what is the impact on the cash flow. So we need to understand also what is it says there in the suggested solution, the impact on giving and receiving prompt payment discounts can be considered. Now also in the suggested solution it says that monitoring future cash flows will allow any cash surpluses or shortfalls to be identified. Well, given that we're growing the business, I think surpluses are less likely, but it's a possibility. And then it tells us that surplus cash could be invested. Again, seems unlikely for Flush. But if we'd have insufficient cash, then loans, overdrafts, or possibly we need to sell some more shares. So we need more equity to accommodate any of those shortfalls. So if you didn't get that answer, I think that's a reasonable one because there's no hint of any of that in the scenario provided. Let's move on to the next part of the question. So it tells us that we've got some extracts for the cash budget for April. And what do we have? We've got some cash received from cash sales. We've also got cash received from credit sales. We also have our receivables at the end of the month and our closing cash. We're also told that receivables at the end of March, that's at the beginning of April, is 650,000. And then we've got our actual sales, and that's going to be a combination of cash sales and credit sales, and that was 133,000. The task asks us to identify two deviations from the cash budget, including the deviation percentage. And we should show our percentage to two decimal places, and then also explain a potential reason for the deviation. So notice of the information they've given us cash sales, credit sales, receivables, and cash. Well, of those four, receivables isn't really cash, so I don't think we can really talk about that, but we can talk about the other three. So let's start with our cash sales. So we actually had 18,000 compared with our budget of 25,000. And if we divide one by the other, we get 0.72. So that tells us that we have a 28% reduction compared with budget. So why is this smaller than planned? Well, to help us build up some marks, now in this case we're only going to get 1 mark anyway, but perhaps in your assessment there may be more marks. So let's remind ourselves, how do we work out that cash sales figure anyway? So you can see there at the bottom of the screen that revenue is going to be the unit sold multiplied by the unit selling price less any discount. So do you see there are 3 contributory factors there to why we have 7,000 less than planned? It could be we sold fewer units. It could be that the unit selling price is smaller, or it could be that we've been giving a bigger discount. Now we only need one of those, but any of those 3 could have been discussed as your answer. So let's move on to credit sales. So we have actual credit sales, or rather cash from credit sales, of 105,000. And if we divide by the 200,000 budget, that gives us 0.525. So that means that we have a 47.5% reduction compared with budget. So what was the cause for this? Now remember, in the text we've been given further information. We've been told about receivables, haven't we? Because what we know is that the cash coming in from the sales has gone down, but what about the sales themselves? Are they better or worse than budget? So given that we've been given the opening and closing trade receivables, we can use that to try and work out what the sales were. We have to be thinking all the time in these assessments, why has the examiner given us the closing and trade receivables? What's the point of that? Well, we can use a T account. So let's start off with our budget, and we're going to prepare a T account for our receivables ledger control account. So remember that we have an opening balance of 650,000. So that was given to us below the table. And then our budget carried forward balance was 550,000. We know that our budget was that we were going to receive cash of 200,000. So that means we can balance off our account now. So we've got a total of 750,000. And that means we can now work out our missing number, our balancing figure, which must be our credit sales. So our budget, our plan was that we were going to make sales of 100,000. Now let's compare that with actual. How did we actually get on? Again, we're still looking at our receivables ledger control account. Our brought forward balance is the 650,000, but we actually had a carried forward balance of 660,000. And part of the reason for that is that we received less cash from our customers, only 105,000. So again, if we balance off our account, that gives us a missing balancing figure for our credit sales of 115,000. So notice that sales were actually better than planned. Now for our cash sales, the number simply goes down, so we have fewer sales, but now for the credit sales, it was better than budget. So the fact that our cash collected has gone down has got nothing to do with our sales volume. So instead, it must be more related to the timing of the cash flows. So we sold more, but collected less. So it must mean that more people have just delayed paying us. So in our answer, we can say that credit sales were 115,000 compared with a budget of 100,000. And in fact, let's just make sure we're happy with that, because look, we've got our total sales of 133,000, haven't we? Of which 18,000 were the cash sales, so the remaining 115,000 must be credit sales. So yeah, so credit sales were higher than planned, which is good, but we collected less money than planned, so it must be that our credit customers who owed us money still haven't paid us. Now that must be the cause of this deviation. Now, only 2 deviations were required, but there is a third you could have talked about as well in your answer as a replacement for any of the other 2. So let's look at the cash position. So we have cash at the end of the month of 156,000. If we divide that by the budget of 250,000, that gives us 0.624. And that means we have a 37.6% reduction compared with budget. Now, what's the reason for this? Well, it's a combination of what we've been talking about so far, that we have worse credit control, we've not collected the money from our credit customers, and we sold fewer things in terms of our cash sales. Part 3 asks us to recommend one corrective action that Flush could take for these deviations, and the key one is probably reviewing the credit terms. If we've made the sales already, that's great, but we just need people to pay us more quickly. So we need to improve our credit control and start hassling people so they pay us on time. There are other possible answers here as well, and you can look at AAT's suggested solution to see those, but the key one for Flush is probably about credit control. Moving on to Part C, the accountant of Flush Limited has stated that the business may be at risk of overtrading, and we need to state what overtrading means. So overtrading is when we're spending lots of our cash on growing the business and on expansion, and that means there's no cash available to meet our obligations, our day-to-day obligations, such as paying the salaries of our staff, for example, paying our suppliers. And Part 2 asks us to state 3 reasons why the accountant may be concerned that Flush is at risk of overtrading. Well, we know, don't we, that we have rapid expansion. So that's a typical cause of overtrading. And we also know that we have no cash, or we have less cash than planned. Remember, it's only 156,000 compared with 250. And linked with that is that we have poor credit control. But there are some other reasons as well. We also know that we have an increase in inventory. Remember, at the beginning of the text, and again, notice the technique here, that we may need to use information at the beginning of the question to help us answer part of the end of the question. So we know that we've got more inventory, we've got more working capital, so that's going to be a drain on our cash resources. And remember, we're doing that because of that rapid expansion, which we mentioned already. We know that we have poor credit control. They gave us that information at the beginning as well. And also, we're less regularly taking advantage of our prompt payment discounts. Now, remember, we could pay less money to our suppliers. This would be cheaper. We could reduce our expenses if we paid them early. But because we have no cash, we can't do that. So that's also an indicator that we may be overtrading.